management. That is the topic of discussion in this video. At the end of this video, learners should be able to define inventory, define terminologies in inventory control, define economic order quantity, compute economic order quantity and related measures. I'm Abdullahi Okoyemi Falade, Operation Research Facilitator. What is inventory? Inventory simply means usable resources that brings in earnings when it is dynamic. Any resources you can think of that can one way or the other generate earnings for you, be it your finished goods, be it your raw materials, be it semi-finished goods, and any other resources you can talk about is your inventory. In an organization, various types of items are usually stored as inventory. Inventory are kept in order to ensure that shortages of needed goods are averted. In inventory control and management, we are interested in three things. 1. When to place order. 2. How much order do we need to place? 3. How do we minimize the total cost associated with inventory? Once again, in inventory control and management, we are interested in three things. When to place order, how much to order an inventory item, and emphasis on the minimization of total costs associated with inventory. We have several terminologies in inventory control. In this video, we explain some of these terminologies. 1. We have the procurement time or lead time, which simply means the time interval when you place an order and when your order is received. Demand, that is the amount required for sales. Demand, it's an amount required by sales, production, which is usually rate of demand per annum. It's usually expressed as a rate of demand per annum. We have the economic order quantity, sometimes called best order size. It is a calculated ordering quantity which minimizes the balance of cost between the inventory costs, which can also known as carrying costs, and the reorder costs, which is also known as ordering cost. So the quantity at which we are trying to minimize the cost between this ordering and reorder cost is considered to be the economic order quantity. Physical stock, as the name implies, means number of items you have physically in stock at a given time. The free stock is physical stock plus outstanding replenishment orders minus unfulfilled requirements. The buffer stock or minimum stock, also known as safety stock, it is the stock allowance to cover errors in forecasts. So the stock allowance to cover errors in forecasting the lead time or the demand during the lead time. And we have explained earlier what the lead time is, the time interval between when you place the order and when you received the order. And this could be in days, it could be in months, it could be in years, depending. But the earlier, the better. The maximum stock is the stock level selected as the maximum desirable. which is used as an indicator to show when stocks have risen too high. So the maximum stock is like a threshold that helps you to determine when you have reached the maximum level of stock. So the other level is the level of stock at which a further replenishment order should be placed. And the quantity at this level is called the reorder quantity, the quantity of the replenishment order. Those are some of the terminologies. Why do we need to keep inventory? Why inventory control? Number one, smooth out variations in operation performances. And it also helps to avert or to overcome stockout or shortage. It helps to safeguard against price changes and inflation. And inventory control also helps us to take advantage of quantity discount. If you are watching this video for the first time, do not forget to press the subscribe button, like, share on your social media platforms, and add comments, if any. Some costs in inventory control and management are item cost, which is the actual purchase price of an item, ordering cost, which is the cost associated with placing an order, clerical and administrative cost, transportation, and inspection cost. It's considered to be a fixed cost, irrespective of the price of order. We have the holding or carrying costs. This is cost of carrying a given quantity of inventory. It is considered to be a variable cost. It changes with respect to quantity. These costs include interest on capital invested in the stock, storage charges, insurance and security, handling costs, privilege stealing, deterioration costs, and cost of obsolescence. We also have the stockout cost, which is caused by delay of stock between supply and demand. These costs include cost contributions as a result of future sales, etc. Now we want to talk about economic order quantity analysis. We have explained earlier what economic order quantity means. It is an ordering quantity that minimizes the balance cost between inventory holding cost and reorder cost. But at this point, we want to talk about the basic EOQ, the assumptions behind the basic EOQ. In a basic EOQ, it is assumed there is a known constant stock holding cost, there is a known constant ordering cost, a known demand, a known cost, a known constant price per unit. And at that point, the replenishment is made instantaneously at any given instant in time. And no stockout is allowed for basic economic order quantity. So the formula is square root of 2c naught d over cc, or square root of 2c naught d over h. The c naught is the ordering cost per order, the d is the demand per annum, the cc is the carrying cost per unit per annum. A typical example of how to apply this formula is given in the first example. A company uses 50,000 certain material per annum, which are 10 naira each to purchase. The ordering costs are 150 naira per order, and the carrying costs are 150% per annum. Calculate the EOQ. How do you do that? It's as simple as taking out the parameters in the equation, input in the formula. Simple. So the ordering cost is given as 150 naira. The demand is 50,000 materials. I mean 15% of 10 naira. You multiply the 15% by the price each to purchase, and you have 1 naira 50 kobo. Substitute into the formula, and you have 3,162 materials. Take note, it's a quantity, not a cost. Don't put naira, don't put dollars, don't put the currency. It's a material. Or you can say 3,162 units. The second version of EOQ is EOQ with stockout. When the stockout is allowed, you'll be given the stockout cost. And the formula changes. Square root of 2C naught D over CC times square root of CC plus CS over CS. As stated earlier, the C naught is the ordering cost, the D is the demand, the CC is your carrying cost. Sometimes it could be replaced with your holding cost. And the CS is your stockout cost. In addendum to the previous example, we have an additional information. The stockouts occur and an order is received for materials the firm has agreed to retain the order, and when replacement is received with delivery cost of 75 kobo per material. Other costs associated with stockouts are estimated as 25 kobo per unit. Find the EOQ. So we can observe that we still use the same parameters, just that there's additional parameter and that is the mentioned delivery cost and the stockouts estimated other costs associated with stockouts, which is 25 kobo, and the addition gives 1 naira. So when you substitute these parameters into the formula, you get 4,996 materials. Now, the third version of EOQ is EOQ with shortage, economic order quantity with shortage. All assumptions made on EOQ which no stockouts are allowed are upheld. It is also assumed that shortage are allowed, in addition to other conditions as earlier stated. So then we have the EOQ as square root of 2k d over h in brace bracket h plus sc over sc close the bracket. So the k is your ordering cost. The c naught has been replaced with k. D still remains the demand. H is still your holding cost. H is your holding cost. Sc in this context is your shortage cost. Other related measures after you have calculated your EOQ for computation that involve shortage are optimal stock level, denoted by M star. It's just like you turn this place upside down. The 2kd over h remains the same. And the optimal shortage level will be S star. It's not a name of a person, it's a symbol, S star, which is equal to the Q star, which is the economic order quantity, minus M star, which is the optimal stock level. So optimal shortage level equals economic order quantity minus optimal stock level. Data cycle time is square root of 2k over dh, open the bracket, h plus sc over sc. In a more simpler form, it is equals to the Q star, which is the EOQ, divided by demand. The total variable cost is given as square root of 2k dh, open the brace bracket, sc over h plus sc, close the bracket, and sometimes regarded as optimal cost. This is an example of how to apply the last formula for EOQ with shortage allowed. this case, you'll be given all the parameters needed. A food and beverage company based in Lagos usually supplies its products at a constant rate of 2,000 units per month. If the company can supply any amount of its product at any required time with each ordering cost of 500 naira, holding cost of 20 naira per unit per month, and the penalty cost of delaying supply of 100 naira per unit per month, find the EOQ, the optimal stock level, the optimal shortage level, the total cycle time. So the parameters are clearly stated. The demand is 2,000 cost per month. K is 500 naira per order. H is 20 naira per unit per month. And the shortage cost, which is 100 naira per unit per month. So you can observe that all the given parameters are uniform, always per month. So there is no need for conversion. You apply a formula straightforward, input those parameters into the formula of EOQ, you get 346.4 units. For the optimal stock level, you get 288.7 units. And for the optimal shortage level, which is the difference between these two values, Q star minus M star, you have 57.7 units. And lastly, if you use this formula, you can also use a simpler formula, which is Q star over D, which is equals to 0.17. Some formulas that could be of interest to you are total variable cost, which is equals to demand times CI plus Q over 2H plus D over Q C naught. So in some cases whereby you need to compute the total variable cost and you have the demand, you have the ordering cost, you have the EOQ already given in the question, you have the cost per item. You can easily use this formula to determine the total variable cost. If the questions involve finding only the holding cost, the formula is Q over 2 times H. If it involves calculating the ordering cost, it is D over Q times C naught, which is ordering. Number of orders is equals to D over Q, and the average stock is equals to Q over 2. Number of orders is given as annual demand over Q star. The time between orders is number of working days per year divided by number of orders. And the other point is equals to daily demand times lead time plus safety stock. Once again, do not forget to press the subscribe button so that you can enjoy more videos. So this is another miscellaneous example in inventory that involves normal usage, minimum usage, maximum usage, lead time, and EOQ. If you're asked to determine the reorder level, you just need to multiply the maximum usage and the maximum lead time. The maximum usage is 1,800 multiplied by the maximum lead time. Out of the lead time, we have 24 and 28. The maximum is 28. That's why we have 1,800 times 28. Punch that in your calculator and drop the answer at the comment section of this video. For the minimum level, we have the reorder level minus average usage of average lead time. So the reorder level is what you have obtained here, which is 180 times 28 minus, how do you compute your average usage of average lead time? So to do that, you have your normal usage, which is 1,375 times average lead time, which is 24 plus 28 divided by 2. Drop your answer at the comment section. Okay, thank you. For the maximum level, you need the reorder level plus the EOQ minus minimum anticipated usage lead time. And that is 1,800 times 28 plus EOQ, which which is 25,000, minus the minimum anticipated usage lead time, which is 1,000, which is the minimum usage, times minimum lead time, 24. Drop your final answer at the comment section of the video. Thanks for watching and bye for now.